Hey everyone, Fintech here. My stock portfolio is currently up over 8% in just the last month, bringing the total up over 70% year to date. In this video, I'm going to reveal my now over $200,000 stock portfolio and show you what I invested in to achieve those gains. In this video, I'm going to walk through exactly which stocks I am holding in my different stock accounts, show you how much money is in each position, and talk about why I picked each stock to invest in. And at the end of the video, I will also talk about what trades I am making in the companies that I hold, including 4 total trades with 1 company that I sold out of completely. And for full transparency, the portfolio I will show you does not represent my entire investment portfolio. It is only my individual stock positions. I hold a separate investment account in my company's 401k, which I invest into an index fund. So hit the like button if you appreciate me showing you every detail that I can think of about my trades and my portfolio. I do it because I want to be transparent, and I think that some people can benefit from it. But let's not waste too much time, and let's go ahead and pull up my brokerage account and start going through my individual stocks. So I have pulled up here my Charles Schwab portfolio, which I use because it gathers up all the different stocks that I own across all my accounts into one place. Now, as we can see here, we can view how much my personal value has changed over time in this account. So let's say we go to the 1 month view, we can see that it's up over 8% during that time. Or if, say, we looked at the year-to-date value, in that same time, it's up 70% year-to-date. But it hasn't all been smooth sailing on that ride. You can see here that from around January through, it looks like the end of February, it was all pretty much uphill, but then we had a pretty substantial crash from February through March. Then the stock market rose again up and through around May. And then in May, we once again had a pretty dramatic crash, dropping all the way from $162,000 to $137,000. Now, when you see that happening in your portfolio, it's easy to panic and think you need to pull money out of the market. But I kept my money invested, and it rose pretty steadily up through September, when it had, again, a temporary crash at the start of October, and then it's recovered somewhat since then. Now, if we scroll down a little bit, we can see the different accounts that are actually being gathered together here. Now, we're gonna go through a mix of both my taxable brokerage account as well as my Roth IRA account, which is not taxable. But we'll talk about the difference between those two accounts a little bit later. Right now, let's just dive into the stocks. So the largest position here is a company called Datadog, which we can see here that I own 381 shares of at a market value of $56,800 and a cost basis of just under $25,000. So in total, this is more than a 100% return on investment. What Datadog does is make it easy to view your applications, your security, and your infrastructure all through what they call a single pane of glass. This makes it really easy for someone running a company to actually extract value from their data. This company is growing incredibly quickly, has really high margins, and a really high dollar-based net expansion rate, meaning that once customers start to use it, they tend to spend more on it every subsequent year. Plus, as we see data start to explode more and more, especially with more and more companies moving to the cloud, the general macroeconomic trend is going to be in favor of Datadog as well, which is why this is my highest conviction position overall. Next up, we have Cloudflare. Cloudflare is my second largest position with 337 shares at a market value of just under $53,000, and that has a cost basis of under $20,000. So in total, I actually have an even larger gain on this stock off of an even smaller cost basis. So again, over a 100% return. Cloudflare is working to make the internet itself work better. They started out by offering CDN services, basically hosting websites, and then they realized that they could optimize those websites to make it easier for good actors to use them and make it harder for bad actors to attack them. They're basically taking the 1980s technology that the internet is built on top of and modernizing it for the 21st century. This company is growing at around 50% per year like clockwork for several years now, and they also recently obtained FedRAMP approval, which should give them even more opportunities to sell to more clients, including the federal government. And the only reason this isn't my largest position is because it isn't growing quite as quickly as Datadog. Third on my list is CrowdStrike. CrowdStrike I currently own 194 shares of at a market value of $50,000, and that's off an even smaller initial investment of just over $17,000. So again, well over a 100% return, and this one is almost at a 200% return. CrowdStrike, in my opinion, is the best cloud security company in the world. Unlike a lot of other legacy security companies, CrowdStrike was built from the ground up in the cloud, which means all of their tools work really well for protecting cloud workloads. CrowdStrike got a bunch of attention when they it helped mitigate the SolarWinds attack. CrowdStrike is also growing incredibly quickly, and that is why it rounds out my top 3 largest holdings. Now, if you watched my review from last month, you may notice that CrowdStrike has gone from my largest position overall to my 3rd largest. Now, this isn't because I've sold any of the stock within CrowdStrike, it's just because I added some money to Datadog and Cloudflare just increased in value faster than CrowdStrike did. Realistically, these companies are going to grow at different paces at different times, so it's hard to say when any of these 3 companies will be the largest overall, so expect some fluctuation between those. But next up, we have Upstart, which is a relatively new entry to my portfolio. I own 112 shares of Upstart at a value of $37,000, and that's off an initial investment of $18,000. So once again, over a 100% return on investment. What makes Upstart special though is I've only owned it for around 2 or 3 months at this point. Upstart is applying AI to the loan market. So historically, the way that you are qualified for a loan is based on your FICO score, which is just a single number. But Upstart takes thousands of numbers, runs them through a machine learning algorithm, and then outputs whether or not you're going to be qualifying for a risky loan or not. This allows them to A, offer loans to more customers who might not qualify under a traditional FICO score, or B, offer lower rates to customers who maybe have a decent FICO score, but Upstart's AI thinks that they're an even better borrower than their FICO score shows. Right now, Upstart is completely dominating this small niche, and they are growing very, very quickly, and they are going to soon start expanding out of just the personal loan market that they started in and into other areas of lending as well, such as auto lending. So watch for this company going forward because chances are it's going to enter my top 3 largest positions at some point in the future. After Upstart, we have ZScaler, which I own 60 shares of at a value of $17,000, and that's off an initial investment of $16,000. So only about a $1,000 gain so far, but to be fair, that's because this is also a very new position in my portfolio. ZScaler also operates in the security space, but they don't compete directly with CrowdStrike. What ZScaler does is offer zero trust security. So as a bunch of companies are moving a lot of their infrastructure into the cloud, they have a lot more traffic over the open internet. What Zscaler does is set up a system where you don't have to trust that traffic. So in a traditional company, you would just set up a siloed network and anything that came in or out would be checked, but once you're in the network, you're good. You can do anything you want in there. With Zscaler, anytime one device wants to connect to another, there has to be a check to see that that device is who it says it is. This is super important for people working remotely, for people installing IoT devices, or for people moving to the cloud. And Zscaler actually integrates directly with CrowdStrike's Falcon endpoint protection platform, meaning that as one of them grows, it should help the other company grow as well. After Zscaler, we have ZoomInfo, which I own 168 shares of at a value of $11,000, and that's off a $10,000 initial investment. So again, it's up just over $500. Now this is also a relatively new position for me. It's probably 3 or 4 months old at this point. And what ZoomInfo does is connect salespeople to people in a company who want to buy their product. It has nothing to do with Zoom, the company that I used to own. By offering this service, they make it easier for salespeople to find the people who actually want to use their product, and they make it easier for people who might actually use the service that those salespeople are looking for. So it helps both sides of the equation. ZoomInfo is also growing very, very quickly at this point, although it's not my largest position because it's a little bit outside the realm of the companies that I'm most familiar with, so I'm not as comfortable making this, say, a top 3 position. After ZoomInfo, we have CLimited, which I own 23 shares of at a value of $8,000, and that's off an initial investment of around $5,500. So it's made around $2,500 since then, or around a 50% increase. CLimited, you can kind of think of like the Amazon of Southeast Asia. They have an e-commerce business, they have a digital finance business, and they have an e-gaming business, including Garena Free Fire, which was the largest mobile game in the world. CLimited is growing extremely quickly and moving out into regions outside of Southeast Asia. For example, they've had a ton of success in Brazil, and they're also moving into Mexico. The only reason this isn't a larger position for me is because of the e-commerce aspect, and that's just a brutally competitive business when you're competing with companies like Alibaba and Amazon, but CLimited is somehow pulling it off. It'll be interesting to see if they ever expand into markets like the United States or Europe, where companies like Amazon have a bigger foothold, but for now, I'm happy owning a relatively mid-sized position in this company. After CLimited, we have GLBE, which I have 102 shares of at a value of $5,700, and that's off an initial investment of $6,800. So this is the only position I hold that has lost money. Granted, I've only held it for around a month, so it hasn't really had any time to grow quite yet. GLBE is a platform designed to accelerate e-commerce across international borders. So we obviously have companies like Shopify, which allow normal people to build e-commerce websites and then ship out products to people domestically, but in order to make those same transactions internationally, there's a lot more complexity involved. GLBE is focusing specifically on that problem, and they'll actually integrate with a platform like Shopify to make it easier for them. This is still a somewhat smaller position for me because I still haven't done that deep dive that I said I was going to do. But once I do that, I'll either build this up into a full larger position or I'll sell out of the company completely. After GLBE, we have Snowflake, which I only own 4 shares of at a value of $1,300, and that's off an initial investment of $1,100, so it's made about 20%. Snowflake offers a data management service, which is an order of magnitude less complex than managing your own data in the cloud. Every single one of their customers love their product, and this company has really been kind of a darling of the stock market ever since it IPO'd. The only problem is, even though it's growing incredibly quickly, like 100% per year quickly, it's also incredibly richly valued. It's probably the most expensive stock on this list in terms of its price to sales. Because of that, I've kind of slowly shrunk my Snowflake position over time until the price comes down to a more reasonable level. It's going to take an incredible amount of growth to outgrow their already ridiculously high expectations for the stock. And so I would rather put that money into higher conviction positions like, say, Datadog, Cloudflare, or CrowdStrike. And then lastly, we have my smallest position, which is SoFi, which I own 30 shares of at a value of just over $500. And that's off an initial investment of $420. So it's made about $140. SoFi is a fintech company. Their whole model is to basically land new customers using really cheap customer acquisition avenues, like their mobile app or their stock investing app or their Galileo technology platform, which is like an API for different financial services. They then take all these customers and funnel them down into their lending business, where they can make a lot of money per customer. Ultimately, SoFi's goal is to build an ecosystem where they become a one-stop shop for customers, where they don't have to have their banking or their stock trading or their mortgage all at different locations, and they can all live in one place in the SoFi app. Now you'll notice that certain of these stocks here have a number 2 next to them. And that's because I own them both in this Charles Schwab portfolio as well as in my Vanguard Roth IRA account. Now the reason I put money into my Roth IRA is because any stocks that I buy in that account can grow completely tax-free forever. So if I wanted to, say, trade stocks on a daily basis, there are a lot of tax consequences for that in having short-term gains. But in a Roth IRA, it doesn't matter. You can basically do whatever you want. Because of that, I always try to put $6,000 into my Roth IRA every single year and max it out. Now, something that some people may call out when looking at these companies are their varying price to sales ratios. For example, Snowflake has a very high price to sales ratio versus something like C Limited has a relatively low price to sales ratio. But the important thing to focus on here is that price to sales ratio only tells you a very small portion of the overall story. Yes, C Limited has a lower price to sales ratio, but that doesn't necessarily mean it's a better value because it has very low margins because of e-commerce. For example, let's say C Limited spent $100 million in order to generate $100 million in revenue. Well, that would make their price to sales ratio look really good, but it wouldn't actually do anything to help the business. Because of that, it's really hard to compare price to sales ratios with extremely high margin businesses like a software business with a business that has a lot of physical parts that have to move around, like an e-commerce business like C Limited. So if you see any YouTubers out there trying to compare these two types of stocks directly, just take that with a grain of salt. Now lastly, I promised that I would talk about any trades that I made in this portfolio in the last month, and there were 4 total trades. First off, I sold a little bit of Cloudflare, around $3,000. The only reason I did that is because Cloudflare at the time was sitting as the largest stock position in my portfolio. And to me, that didn't really make sense because Cloudflare was growing at around 50% per year, while Datadog was growing even faster than that. Yet at the same time, Cloudflare was valued a little bit more highly in terms of their price to sales ratio. And this is an example where comparing the price to sales ratio is actually useful. So even though I still believe in Cloudflare and I think it's a fantastic company, it doesn't make sense in terms of how confident I am in the companies to have it as a larger position than Datadog. Which leads into one of the other trades that I made, which was essentially adding that same amount of money to Datadog. And there's a chance that I will sell out a little bit more Cloudflare later on, just to boost up some of these other positions as well. The other position that I added to this month was Upstart, which started out as kind of a mid-tier position, so similar to maybe like ZScaler or ZoomInfo, but I've slowly built it up to where it sits in this kind of midpoint between my mid-tier positions and my 3 largest positions. Over time, I wouldn't be surprised if I build this into one of my largest positions because this company is performing extremely well. And then lastly, I actually completely sold out of one of the stocks that I had in my portfolio last month, and that was DocuSign. Now, DocuSign is the leader in the e-signature market, and they're still performing really well, but I just question how much they can continue to grow once they've basically completely dominated their existing market. So I've been slowly selling out of the company since the beginning of September, and I talked about it in my last portfolio review, but I finally pulled the trigger and completely sold out this month. Now, I'm not advocating for market timing, but my timing was pretty lucky with when I sold DocuSign because it's down around 5% for the month, and the stocks that I added the money to, such as Datadog, are actually up around 11% in that same month. It's anecdotal, but it does kind of illustrate why it's important to have no mercy in trimming positions that you've lost confidence in. Now, if you like these kind of updates and you'd like a little bit more information or to hear about them a little bit more often, I'm starting a Patreon where I'm going to provide real-time updates when I make these kind of trades. Now, I'm not going to remove any kind of free content from this channel. I'll still be explaining everything here. You can just go there if you want to support the channel and get that news a little bit earlier. Don't forget to like and subscribe, and I'll see you next time.